and I'm the Chuck in the Market Sub-Chuck. And today's blog was titled Back to School, and the purpose of today's blog is really to, continue this theme that I've had, and I've been blogging about all the time about how important it is to look at individual companies and not at stocks or even what the market's doing. We're going to look at three companies today in the same industry. We're going to look at them from the same time frame. We're going to look at them through the same economic environment. And we're going to look at companies that are in basically the same business, as I stated. And what you're going to see here is a radical difference in not only how the companies have performed as businesses, but also in how shareholders were rewarded as owners of those companies. The first is OfficeMax. We're looking at a 20-year chart here. I want you to notice this company has had really, if you just instantly look at this chart, you can see that the earnings power of this company has been very erratic. Earnings have risen and fallen, risen and fallen, risen and fallen. And if you look at the stock price, the highs and lows, if you look up here at the top, going back almost 20 years here, you'll see that there's really been nothing going on in this stock. Investors or shareholders in this company have actually lost money even at a time when the market itself, averaged about 6%. Long-term owners of OfficeMax would have lost a minus 3.8%. So here's one company in the office industry, and if you just looked at this company alone, you might think that the office supply industry wasn't too good. If we now move to Office Depot, which is a bigger competitor, I want you to notice that Office Depot did have some really good earnings all the way up through, calendar year 2006. And I do want you to notice how the stock price correlated to that. There's always going to be volatility in stock prices, but look how the stock prices do follow earnings. The earnings were rising here and stock prices rose. They flattened. That brought stock prices down. Earnings rose again, stock prices rose again. Earnings fell, stock prices fell. We had a 2-year recovery. We had a recovery in stock price, but then earnings fell again, and stock price fell. Then we had a couple of good years, and then, of course, we had the fallout in earnings during the recession. And once again, you have a company where the shareholders did a little better than they did at Office Depot. They averaged about 4.7%, but they underperformed, the general stock market. But the same industry as OfficeMax, Office Depot clearly did a lot better, but it did have some real strong problems, more recently. And then finally, the last and the leader in the industry, and certainly the biggest at over $16 billion in market cap, is Staples. I want you to notice how earnings correlate almost perfectly. There was a time when the market overvalued Staples. Of course, it came back. There are times when it undervalued it. It always tracked its earnings. We did have a drop-off in earnings due to the recession, but I do want you to notice that Staples stayed very profitable. The fact that it's green here shows that they still had very strong earnings. They weren't losing money or going out of business, but they did have lower earnings than they had in previous years. But they've had almost a 24% long-term growth rate of earnings, and interestingly enough, shareholders have averaged almost 20.1% or almost 21% in that same market that only did 6.3. So it's not about the economy. It's not about the time frame. It's not even about the industry in this example. It's about how well each of the individual companies within those respective industries are managed. I hope this gave you a good perspective on the importance of how well the company is to long-term shareholder returns. In the short run, stock prices rise and fall together, but in the long run, what separates the good from the bad is the quality of the management of the company and its ability to generate long-term shareholder value through the growth and profitability of the business. Chuck Carnevale saying thanks for listening. Talk to you again.